The debt ceiling is a limit on the total amount of money that the United States can borrow to fund the government and meet its financial obligations. It was created by Congress during World War I to give blanket authorization for the Treasury Department to borrow money up to a set amount. The current debt ceiling is $31.4 trillion, which was reached on January 19, 2023. Because the federal government spends more than it collects in taxes, it has to borrow huge sums of money to pay its bills. Those bills include Social Security payments, interest on the national debt, and salaries for the military. However, raising the debt ceiling does not authorize any new spending. It simply allows the United States to pay for what it has already spent. If Congress does not raise or suspend the debt ceiling, the Treasury Department will run out of cash by June 1, 2023. This means that the United States will default on its obligations, which could have disastrous consequences for the economy and the global financial system. A default could trigger a spike in interest rates, a plunge in stock prices, a loss of confidence in the dollar, and a downgrade of the U.S. credit rating. To avoid this scenario, Congress has to act quickly to either raise or suspend the debt ceiling. However, this is easier said than done. In recent years, the debate over the debt ceiling has become highly partisan and contentious. Republicans have demanded spending cuts and other reforms in exchange for raising the debt limit, while Democrats have insisted on a clean increase or suspension without any conditions. In 2021, Congress agreed to suspend the debt ceiling until December 3, 2022, as part of a bipartisan deal to fund the government and provide COVID-19 relief. This means that until that date, there was no limit on how much the United States could borrow. However, after December 3, 2022, the debt ceiling was reinstated at its previous level plus whatever additional debt was incurred during the suspension period. This is why the United States hit its debt limit on January 19, 2023, and why Congress has to act again before June 1, 2023, to prevent a default. President Biden and Republican and Democratic leaders are currently negotiating a path forward, but it is unclear how they will resolve their differences and reach a compromise. The stakes are high, and time is running out. The debt ceiling is the legal limit on how much the federal government can borrow to pay its existing obligations, such as Social Security benefits, military salaries, and interest on the national debt. If Congress does not raise or suspend the debt ceiling by May 31, 2023, the U.S. Treasury will run out of cash and extraordinary measures to avoid defaulting on its obligations. This could have severe consequences for the economy and the financial markets. What are the potential risks and opportunities for investors in different sectors and asset classes if the debt ceiling is not raised or suspended in time? One of the most immediate risks is a sharp increase in interest rates, as investors demand higher yields to lend to the U.S. government or sell their treasury securities. This would raise the cost of borrowing for businesses and consumers, and reduce the value of fixed-income investments. Higher interest rates could also trigger a sell-off in the stock market, as investors shift their money to safer assets or anticipate lower earnings growth for companies. Another risk is a downgrade of the U.S. credit rating by major rating agencies, such as Standard & Poor's, Moody's, and Fitch. This happened in 2011, when S&P lowered its rating on U.S. debt from AAA to A+ after a prolonged debt ceiling standoff. A lower credit rating could further erode investor confidence in U.S. debt and increase borrowing costs for the government and other entities that rely on its creditworthiness. A third risk is a recession or a slowdown in economic growth, as a result of reduced government spending, lower consumer confidence, and disrupted financial markets.